Welcome to this comprehensive guide on building wealth through a hybrid investing strategy, combining the stability of broad market ETFs, the high income of covered call ETFs, and the growth potential of cryptocurrencies like Bitcoin and XRP. Today, we'll explore how a young investor, still in university and working multiple jobs, built a $21,000 portfolio with a remarkable 54.08% distribution yield, primarily driven by covered call ETFs from YieldMax, Harvest, Defiance, and Granite Shares. This portfolio, balanced with a significant allocation to the Vanguard S&P 500 ETF, VFV, and a small crypto position, offers a blueprint for young investors aiming for financial independence and early retirement. We'll dive into the strategy, benefits, risks, and practical steps to replicate this approach, all while emphasizing the importance of discipline, research, and diversification. Please note that this presentation is for entertainment purposes only and does not constitute financial advice. Always consult a financial advisor before making investment decisions. Imagine being a 20-year-old university student juggling multiple jobs and building a $21,000 investment portfolio in less than a year. This achievement, verified by the Blossom investing community, showcases the power of disciplined saving and strategic investing. Starting with $18,000 in cash savings from years of hard work, beginning at age 12 with jobs in oil delivery, lawn care, and retail. This investor began their journey just before a major election in 2024. Initially hesitant, they dipped their toes into the market with $150 in Bitcoin and $150 in Ethereum, witnessing a significant surge the next day that sparked their passion for investing. Over the next 2 weeks, they committed $11,000 primarily to VFV, tracking the S&P 500, with smaller positions in Canadian equities like TD Bank and Enbridge. This rapid entry into the market reflects a key lesson. Starting early, even with small amounts, can set the foundation for long-term wealth. The investor's background in psychology, with aspirations to become a psychotherapist, underscores their forward-thinking mindset, balancing academic goals with financial ambition. By working 7 days a week across 3 jobs, they've cultivated a strong work ethic, channeling earnings into investments rather than discretionary spending. This discipline allowed them to allocate $500 bi-weekly from their paychecks to their portfolio, reserving another $500 for savings and using the rest for essentials like gas, phone bills, and future tuition. The portfolio, valued at $21,000, is a hybrid model blending growth, income, and alternative assets. It comprises 9 ETFs from Vanguard, YieldMax, Harvest, Defiance, and Granite Shares, with a 5% allocation to cryptocurrencies. The largest holding, at 34%, is VFV, a low-cost ETF tracking the S&P 500 with a historical average annual return of 7.2%. This forms the portfolio's safety net, providing stability and long-term growth. Approximately 60% is allocated to covered call ETFs, including YieldMax's ULTY, 22%, MSTY and MSTY, as well as Granite Shares XBTY and Harvest's HIS. These ETFs generate a staggering 54.08% distribution yield, driven primarily by YieldMax's high-yield strategies. The remaining 5% in crypto adds speculative growth potential, capitalizing on Bitcoin's bullish trends. The strategy is hybrid, prioritizing both growth and income. Initially, the portfolio was over 50% in VFV, reflecting a growth-focused approach. However, inspired by the financial independence, retire early FIRE movement and insights from the Blossom community, the investor shifted toward covered call ETFs to accelerate portfolio growth through high distributions. These distributions, paid weekly, for example ULTY and XBTY, or monthly, for example HIS, are reinvested to compound returns, either back into income-producing ETFs or into VFV for growth. This flexibility allows the investor to buy dips in undervalued assets, enhancing overall returns. For example, with a $21,000 portfolio yielding 54.08%, the investor generates approximately $11,357 annually, or $946 monthly. Weekly distributions from ULTY, $4,620 at 22% of the portfolio, and XBTY provide regular cash flow, which is reinvested to purchase additional shares during market dips. This approach contrasts with traditional dividend investing, where yields like DGRO's 2 to 3% grow more slowly. By combining VFV's steady 7.2% growth with high-yield covered call ETFs, the portfolio achieves both capital appreciation and significant income, aiming for a goal of $120,000 annually in distributions, $10,000 monthly. Covered call ETFs, such as YieldMax's ULTY and MSTY, Harvest's HIS, Defiance's offerings, and Granite Shares XBTY, are the backbone of this portfolio's high yield. These funds sell call options on underlying assets, for example Bitcoin, Tesla, or MicroStrategy, to generate premium income, distributed to investors weekly or monthly. ULTY, the largest holding at 22%, is favored for its weekly payouts and Bitcoin tracking, offering stability and high income. XBTY, another weekly payer, was added for its higher yield and lower volatility compared to MSTY, which the investor is gradually selling due to its leverage-driven 15% daily drawdowns. The appeal of covered call ETFs lies in their ability to generate substantial income in volatile markets. For instance, ULTY's yield, often exceeding 80%, is driven by selling calls on high volatility assets, capturing premiums that boost distributions. During a recent market dip, ULTY's weekly payments cushioned a 10% share price decline, reducing the net loss to 5 to 6%. This income acts as a buffer, allowing investors to reinvest during downturns, effectively buying at a discount. For a young investor, this strategy accelerates compounding, as reinvested distributions purchase more shares, increasing future payouts. The investor's shift to covered calls was inspired by the Blossom community, where high-income portfolios demonstrated the potential for rapid growth. By selling positions in TD Bank, 30% profit, and Enbridge, the investor reallocated capital to covered call ETFs, reducing VFV's weighting from 50% to 34%. This transition reflects a calculated move to balance risk and reward, leveraging the S&P 500 stability with the high income of covered calls. The investor's preference for weekly payers like ULTY and XBTY stems from their ability to compound quickly, allowing flexible reinvestment into growth or income assets based on market conditions. A hybrid portfolio combining growth, VFV, income, covered call ETFs, and crypto offers several advantages for young investors. First, it provides diversification across asset classes, reducing reliance on any single market. VFV's 7.2% historical return ensures steady growth, while covered call ETFs deliver high income to fund additional investments. Crypto, though only 5% of the portfolio, adds speculative upside, with Bitcoin's 70% surge in 2024 enhancing returns. This mix balances stability with aggressive growth, ideal for a 20-year-old with a long investment horizon. Second, the high distribution yield, 54.08%, accelerates portfolio growth. For example, $946 monthly distributions can be reinvested to purchase 7 shares of ULTY at $15/share, or 4 shares of VFV at $200/share, compounding the portfolio's value. Over a decade, assuming a 35% yield, as the investor plans to moderate, a $21,000 portfolio could grow to $50,000, $60,000, factoring in reinvested distributions and VFV's growth. Third, the strategy aligns with the FIRE movement, aiming for financial independence by age 45-50. With a goal of $120,000 annually in distributions, the investor plans to fund lifestyle expenses, for example cars, family support, and pay off student debt. Covered call ETFs make this feasible by generating income far exceeding traditional dividends, which typically yield 2 to 4%. For instance, a $1 million portfolio at 35% yield could produce $350,000 annually, dwarfing the $20,000, $40,000 from a 2 to 4% dividend portfolio. Finally, the portfolio's flexibility allows dynamic allocation. During a recent 20% dip in Harvest's HIS, the investor lump-summed $1,000, capitalizing on the discount. Weekly distributions from ULTY and XBTY provide regular opportunities to buy undervalued assets, enhancing returns in volatile markets. This adaptability, informed by research on platforms like Blossom, ensures the portfolio remains responsive to market conditions. Despite its strengths, this hybrid strategy carries significant risks. Covered call ETFs, particularly YieldMax's MSTY, are highly volatile due to their leverage and exposure to assets like MicroStrategy, MSTR, a Bitcoin proxy. A 15% single-day drop in MSTY, driven by MSTR's 20% decline, highlights the risk of NAV erosion, where share prices fall as distributions are paid out. While distributions mitigate losses, for example reducing a 15% drop to 10%, prolonged downturns can erode capital, especially for investors who bought at inception highs, for example ULTY down 70% all-time. The portfolio's 54.08% yield, while impressive, reflects its high-risk profile. Newer ETFs like ULTY and MSTY lack long-term track records, making their sustainability uncertain. A recession could reduce distributions if volatility drops or underlying assets underperform, though covered call ETFs often benefit from high volatility. The investor rates their portfolio's risk as 3/5, medium to high, acknowledging the untested nature of these funds, but expressing confidence in their long-term potential. Crypto's 5% allocation introduces additional volatility. Bitcoin's 70% drawdowns, as seen in 2022, could impact the portfolio, though its small weighting limits exposure. The investor's youth and long horizon mitigate these risks, as they can weather downturns by dollar-cost averaging, DCA, buying more during dips to lower their average cost. A common misconception about covered call ETFs is that they're a scam, returning your own money. This overlooks their ability to generate sustainable income through option premiums, as evidenced by portfolios on Blossom where distributions exceed initial investments, effectively creating house money. However, investors must understand the trade-off: capped upside in bull markets due to sold calls, which limit share price gains. For example, if MSTR surges 50%, MSTY's returns may be capped at 30%, though distributions offset this. NAV erosion is a critical concern for covered call ETFs. ULTY, down 70% all-time, exemplifies this, as its high distributions erode share value over time. However, the investor mitigates this by dollar-cost averaging, buying at lows, for example ULTY at $15, versus its $50 inception price. This strategy reduces the average cost basis, softening the impact of declines. For instance, a $1,000 investment in ULTY at $15 yields 66 shares, generating $400 $500 annually at an 80% yield, compared to $200 at $50 per share. To manage volatility, the investor monitors their portfolio daily, making tactical moves like selling MSTY during upswings, for example a recent 5% gain, to reallocate to XBTY, which offers higher yield and lower volatility. This disciplined approach, informed by Blossom's community insights, ensures responsiveness to market shifts. In a recession, the investor plans to maintain their strategy, buying dips with cash reserves and reinvesting distributions to capitalize on discounted prices, confident in the market's historical recovery patterns. The Blossom investing platform, a hub for retail investors, has been instrumental in shaping this strategy. By following high-income portfolios yielding $10,000 monthly, the investor learned about covered call ETFs, transitioning from a growth-heavy portfolio to a hybrid model. Blossom's community provides support, with investors sharing distribution updates and strategies, fostering a collaborative environment. For example, posts about weekly ULTY payouts inspired the investor to prioritize weekly payers, accelerating compounding. However, Blossom also has challenges, including toxicity from growth investors criticizing covered call strategies as risky or unsustainable. This stems from misunderstandings about NAV erosion and option mechanics. The investor counters this by advocating for education, suggesting that critics engage constructively to understand the strategy's merits. Blossom could improve by moderating toxic comments and offering educational resources on covered calls, helping bridge the gap between growth and income investors. The investors' goals are ambitious yet achievable. Within 6 months, they aim to reach $1,000 monthly distributions, $12,000 annually, requiring a $25,000 portfolio at a 48% yield. By age 23, they target a $50,000 portfolio, doubling their current balance, and by age 45, 50, a $5 million portfolio yielding $120,000, $350,000 annually. These funds will support lifestyle goals like purchasing a Dodge Hellcat, paying off student debt, and helping family with expenses, such as their parents' mortgage. To achieve this, the investor plans to continue bi-weekly contributions of $500, reinvesting all distributions into covered call ETFs to maintain high income, while gradually increasing VFV's weighting for growth. Over the next decade, they expect their yield to stabilize at 35%, balancing income with capital appreciation. This hybrid approach ensures flexibility, allowing shifts toward growth if market conditions favor equities or income if volatility rises. For young investors inspired by this approach, here are actionable steps to build a similar portfolio. Start with a safety net. Allocate 30 to 50% to a broad market ETF like VFV or SPY, which offers 7 to 10% annual returns with low volatility. A $5,000 investment in VFV at age 20 could grow to $30,000 by age 40, assuming 7.2% returns. Explore covered call ETFs. Research funds like ULTY, XBTY, or HHIS on platforms like Blossom or YouTube. Start with a 10 to 20% allocation using weekly distributions to compound returns. For example, $2,000 in ULTY at 80% yield generates $1,600 annually, funding additional purchases. Dollar cost average? Invest fixed amounts bi-weekly or monthly to smooth out volatility. For instance, $100 weekly into ULTY over a year, $5,200 total, buys at varying prices, reducing risk compared to a $5,200 lump sum. Limit crypto exposure. Allocate 5 to 10% to Bitcoin or XRP for growth, but cap exposure to manage volatility. A $1,000 Bitcoin position could surge to $1,700 in a year, 70% return, but may drop 50% in a correction. Reinvest distributions. Reinvest all income into the portfolio to maximize compounding. A $10,000 portfolio at 50% yield generates $5,000 annually, purchasing 250 ULTY shares at $20, boosting future income. Educate continuously. Use platforms like Blossom, YouTube, or books like Tony Robbins' Money. Master the game to learn about options, ETFs, and market dynamics. Avoid margin early. While margin can amplify returns, it's risky for beginners. Focus on earned income to fund investments as the investor does to avoid debt-related stress. A hybrid portfolio of growth ETFs, covered call ETFs, and crypto offers young investors a powerful path to financial independence. With a $21,000 portfolio yielding 54.08%, this strategy demonstrates how discipline, research, and community support via Blossom can accelerate wealth building. By balancing VFV's stability, ULTY's weekly income, and Bitcoin's growth, investors can achieve both capital appreciation and high income, targeting ambitious goals like $120,000 annually in distributions by age 45. 50. For those starting out, begin with a broad market ETF, explore covered call strategies cautiously, and leverage platforms like Blossom for education and inspiration. Stay disciplined with DCA, reinvest distributions, and avoid high-risk moves like margin until you're experienced. High-income investing is not a scam, but a tool to outpace inflation and fund your dreams, whether it's a dream car, debt-free family, or early retirement. Visit blossom.com to join the community and learn more. Thank you for joining this guide to hybrid investing. Keep learning, keep investing, and take control of your financial future.